Picture this, two neighbors, both 67, both just retired with $700,000 in super. 12 years later, one is traveling, comfortable, stress-free. The other is cutting back on groceries and quietly terrified about what happens when the money runs out. Same amount, same starting point, wildly different endings. The difference was not luck. It was not the share market. It was not even investment returns. It was 3 decisions made in the first 5 years of retirement that most Australians never think about until it is too late to change them. So today we are going through what $500,000, $700,000, and $1 million actually buys you in retirement. The real weekly income, the real lifestyle, the real choices, and those 3 decisions that separate the comfortable retirees from the ones who spend their 70s anxious about money, right? Let us start where most Australians actually are, because the numbers you read in the news tend to skew high and make perfectly reasonable balances feel inadequate. The median super balance for Australians aged 60 to 64 sits around $200,000. The average is closer to $350,000. So if you are approaching retirement with $500,000, you are already ahead of the vast majority of Australians your age. Worth knowing that straight up, because what follows is about maximizing what you have, not making you feel behind. $500,000. Single homeowner. Retiring at 67. At the government minimum drawdown of 5%, $500,000 generates $25,000 a year from your super account. At that balance, as a single homeowner, you would also likely qualify for a meaningful part-age pension. Somewhere between $15,000 and $20,000 annually depending on your exact asset position. Add those together and your total retirement income sits around $40,000 to $45,000 a year. ASFA's comfortable retirement standard for a single homeowner from their February 2026 update is $54,837 annually. So $500,000 for a single person puts you between modest and comfortable. Not flying business class, but a real, decent, secure retirement. Regular social life, private health insurance, a domestic holiday each year. For a homeowner with no mortgage, that is genuinely livable. Now here is where it gets interesting for couples. $500,000 combined between 2 people at 67. At 5% drawdown generates $25,000 from super. A couple at that asset level typically qualifies for a part pension of around $25,000 to $30,000 combined. Total income $50,000 to $55,000 a year. ASFA's comfortable couple standard is $77,375. So $500,000 between 2 people is below comfortable, sitting closer to the modest benchmark of around $50,000. Tight, workable. But there is not much buffer when something unexpected comes up. And here is the thing about $500,000 that catches people off guard. The drawdown rate matters more at this balance than at any other. 5% is $25,000. 6% is $30,000. That extra $5,000 a year sounds like a reasonable lifestyle upgrade. But at $500,000, drawing 6% instead of 5% can shorten your retirement funding by 5 to 7 years. That is not a small difference. That is the difference between running out at 78 versus 85. Every dollar decision matters at this balance. What if you retire at 60 instead of 67 with $500,000? The bridge years, those 7 years before the age pension kicks in, change everything. Drawing $40,000 a year from 60 to 67 means arriving at pension age with somewhere between $150,000 and $200,000 remaining. At that point, the full age pension becomes likely and helps significantly. But your super is substantially depleted. $500,000 in retirement at 60 requires either careful drawdown discipline, some part-time income in the early years, or both. $700,000. This is where retirement genuinely starts to feel like retirement. At 5% drawdown, $700,000 generates $35,000 a year. A single homeowner at this balance qualifies for a part pension, though smaller than at $500,000 because the assets test reduces it. Somewhere around $8,000 to $12,000 annually. Total income around $45,000 to $47,000 a year. Now you might reckon, wait, that is barely more than the $500,000 scenario. And spot on. The gap is smaller than you would expect. That is the age pension doing its job. It supplements more heavily at lower balances and tapers as balances rise. The practical income difference between $500,000 and $700,000 in retirement at 67 might only be $4,000 to $8,000 annually. Not nothing, but far smaller than a $200,000 difference sounds. The real advantage of $700,000 is not the income at 67. It is the buffer across a long retirement, a health event, a major home repair, a family member who needs help. $700,000 gives you room to handle the unexpected without it derailing everything. And buffer in retirement is worth more than most people appreciate until the moment they actually need it. Here is something worth sitting with. At $700,000, the decision about when you retire carries enormous weight. Retiring at 65 versus 67, just 2 years difference, can mean arriving at pension age with $650,000 versus $550,000. That $100,000 difference affects your age pension entitlement, your income, and your sense of security for potentially 25 years. 2 years of additional working, even part-time, at $700,000 can change your retirement fundamentally. $1 million. The number the finance industry has spent decades telling Australians to chase. The number that feels impossibly large to most, and sometimes curiously underwhelming to those who reach it. At 5% drawdown, $1 million generates $50,000 a year. A homeowning couple with $1 million at 67 typically qualifies for a part-age pension of around $10,000 to $20,000 annually, because $1 million sits well above the full pension threshold but below the part pension cutoff. Total combined income somewhere between $60,000 and $70,000 a year, comfortably above ASFA's standard for couples. For a single person with $1 million, $50,000 from Super plus whatever pension entitlement applies puts them well above the comfortable single benchmark. Here is what genuinely surprises most people with $1 million in Super. As you draw down your balance over time, your age pension entitlement grows. A couple starting at $1 million and drawing sustainably will find their balance at $800,000 after a few years, then $600,000, and at each step the pension tops up more significantly. By their mid-70s, many couples who retired with $1 million are receiving $15,000 to $25,000 annually from the age pension on top of their reduced Super drawdown. The system was specifically designed so Super and the pension work together across a full retirement, not just at the start. Most people plan for year one. Almost nobody plans for how the two interact across 25 years. The drawdown rate matters as much at $1 million as it does at $500,000. At 4%, $1 million generates $40,000 a year and can sustain well beyond 30 years. At 6%, $60,000 a year. That balance is gone in 22 to 25 years depending on returns. For someone retiring at 65, 25 years takes them to 90. That is not an unrealistic lifespan for someone in reasonable health today. The risk of outliving a $1 million balance is genuinely real if the drawdown rate is too aggressive. Now for the strategy that almost no retirement content properly covers. And this one applies regardless of whether you have $500,000, $700,000, or $1 million. The single most powerful thing you can do in retirement is plan your drawdown rate to optimize when you reach the age pension sweet spot, not just to maximize your income today. Here is what that means in practice. A single person with $700,000 at 67 drawing $50,000 a year is initially receiving a small part pension of around $8,000. 10 years later their balance might be around $350,000, and now they qualify for close to the full pension, $31,000 a year from the government. If they had drawn more aggressively in the early years, say $60,000 annually, they might have reached that lower balance at 73 rather than 77. For extra years of full pension support, potentially $50,000 to $80,000 in additional lifetime government income simply by adjusting how much was drawn in the first 5 years of retirement. That is a strategy. That is not luck. And it is available to anyone who plans for it. The other thing no one talks about enough: sequence of returns risk. A bad investment year in year 3 of retirement, when your balance is at its highest and you are drawing the most, does disproportionate damage compared to a bad year at 75 when your balance is lower and the pension is contributing more. The practical response is straightforward. Hold 1 to 2 years of living expenses in cash when you retire. That way, if markets drop in year 2 or 3, you draw from cash instead of selling growth assets at the worst possible time. Simple, effective, and genuinely underused. A few things worth sorting this week based on all of this. Log into your super fund and check whether your account is in accumulation phase or pension phase. If you are over 60 and retired, and still in accumulation, you are paying 15% tax on earnings you no longer need to pay. Moving to pension phase is usually straightforward with your fund and frees up real money every year. Head to servicesaustralia.gov.au and run the age pension payment estimator. Plug in your current balance, then run it again 50,000 lower and 50,000 higher. Seeing how the pension changes across those scenarios gives you a practical feel for how the system responds to your specific asset position. And if your balance is under 500,000 and you have had lower income years, check your carry-forward concessional contributions on MyGov. You may be able to contribute more than the standard cap this financial year and claim a full tax deduction. Every dollar that goes into super in the years before you stop working is worth capturing. The ATO website at ato.gov.au has the full detail on contribution rules and tax. Services Australia at servicesaustralia.gov.au covers the age pension eligibility in full. Both are worth bookmarking. They take time to read properly, which is why this channel exists, to go through it for you each week and translate it into something actually useful. If this gave you a clearer picture of where you stand, subscribe to Super Ease Australia. Every video is built for Australians in their 50s, 60s, and 70s. No products to sell. No jargon to wade through. Just the stuff worth knowing. Drop a comment below. Which of these three amounts is closest to where you are headed? 500, 700, or the million? One line is fine. Helps shape what we focus on next. And as always, for your specific situation, have a chat with a licensed financial advisor or head to ato.gov.au directly. What we cover here is accurate general information for 2026, but your numbers are yours alone.